What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about Inmode, ticker symbol INMD. A lot of you guys have been asking questions about this company because it dropped on a guidance cut moving forward because there's a lot of macroeconomic headwinds. And that's exactly what we are going to discuss in this video. As always, if you enjoy it, find it helpful, make sure that you drop a like. Also, don't forget to subscribe to the channel. If you're just joining us for the first time, it really helps out the channel and helps us grow, create a more engaging community in our Discord as well. And links to our Discord and Patreon is going to be down below if you're interested in joining. It's the first week of the month is the best time to join, and you'll get access to all the members-only private videos, trade alerts, Discord channels, Excel spreadsheets. Everything's going to be included with the link down below. So this right here was the catalyst. So Inmode stock slides 13% after the Israeli medtech company issues profit warning. And I love how they say issuing a profit warning. What it really was a slight decrease in earnings expectations. So they basically cut the EPS to 247 to 250, and that's down from a whopping 253 to 257. That's it. Just about a 7-cent drop in earnings per share, and the stock's down 13%. $485 to $495 million in revenue, and that's down from the prior range of $500 to $510 million. So that's about $15 million is what they have cut in revenue expectations, and earnings basically dropping about 7 cents per share. So again, this right here, as a result, full year 2023 revenue estimated to be in the range of 485 to 495 million. That's down from the prior outlook of 500 to 510 million, and earnings per share between 247 and 250. Prior range was 253 to 257, and analysts were expecting 254 on revenues of just over $504 million. They came in a little bit shy of expectations here, and as a result, the stock definitely selling off quite aggressively. Of course, it was down a little bit over 2.4%, and this week it is down over 15% on the back of these guidance cuts. Now, for those of you who have been following Inmode for quite some time, we know the story. We know exactly how this stock operates, and the management is sometimes too honest for their own good, right? When they come out with these expectations, most likely more times I've seen them cut guidance and then over deliver when the earnings actually get released. It was only up until like this earnings expectations when they actually did miss on EPS and revenue. But every single time in the past, you'll notice a beat. These green over here are beats on both earnings and revenue expectations every single time. Now, considering how high the rates are, it's certainly hurting the overall demand for cosmetic products and equipments. It's a very capital-intensive product that they're selling. And more so, there was actually a very interesting comment that I want to go over from one of the users on Seeking Alpha that pretty much mentioned that a whole thread, without discussing fundamentals of the stock, a lot of demand got pulled forward as every doctor and day spa bought equipment post-COVID. As many people have pointed out, this is capital equipment where revenue resets to zero every year, and they have to sell new equipment. Easily could see 2024 revenue down significantly from 2023. This is what the market is pricing in. Market is not missing the obvious cheap valuation metrics. So this is actually a very good comment. And the reason why I like this is because it kind of tells us the main risk that Inmode basically carries. And that is that there is no stickiness to the business model. There is no subscription revenue. There is no recurring revenue. It's basically equipment that they are selling to surgeons, doctors, spa, everything to basically do these cosmetic surgeries. So yes, the revenue does reset to zero every year, and they have to scale to sell more equipment. So that is actually one of the biggest risks and challenges within Inmode, something that I have mentioned in my previous videos as well. But the company's fundamentals continues to be very, very strong. And I think if the demand is going to be higher for this type of product, especially when rates are on the way down, then of course they've got the opportunity to grow revenues and grow earnings as well, because it's actually a very, very well-run company with some excellent balance sheet metrics and valuations, really cheap, and fundamentals are phenomenal. But again, the market's not looking for past data, it's looking for future data, it's looking for what the future is going to look like for any type of company. And for Inmode, there is that level of uncertainty with, are they going to be able to generate that level of revenue by selling these capital equipments and these machines to surgeons and doctors? And of course, is there any stickiness to the business? Is there going to be some subscription or some type of recurring revenue for the company as well? But if you take a look at the revenue overall, very nice growth, right? Coming from 23 million to well over 498, almost $500 million. Gross profits also gone from 17.4 to 417 million. Operating income from just less than $1 million to now 204 million. So it's basically more than 200 times in terms of that growth. Again, valuation, as I mentioned earlier, is extremely cheap, trading at a little bit over 8 times earnings, and price to sales is just under 4. Price to cash flow a little bit over 9 to 10, and enterprise value to EBITDA trading at just a little bit over 4 to 5. This right here is the earnings expectations. So there's not a lot of earnings expectations that are plugged in right now. So only 3 to 4% growth here. And this is going to be the cash flows that have also done really well. They've gone from like $8 million to now $131, $132 million. And balance sheet is one of the best things. And actually one of the things that is kind of not mentioned in the thread all that much on Seeking Alpha in the comments is the company has a phenomenal, when I say phenomenal, this is about A+ as it get. Like this company gets a huge star and an A+ balance sheet because they've got current quick ratio that is well over 10 to 11. So short-term liquidity is very strong. Debt to free cash flow is less than 1. And we've got more cash than probably all liabilities combined. They've got over $678 million in cash with only $3.5 million of debt. So more cash than debt and more cash than total liabilities also. So that is, again, a very, very strong balance sheet to say the least. So if I actually do some calculations on the business right now, and if we just try to understand, okay, what is going to be that intrinsic value for the company, including both discounted cash flows, reverse discounted cash flow, and all those other types of analysis. If you come over here, I'm going to plug in Inmode. And let's just take a look at their actual free cash flow. We're looking at $131 million on a trailing 12-month basis. We plug in, let's say, 131, and we go with a growth rate of, let's say, 14%. Even at 14%, the company is undervalued by 22%. If I go with, let's say, 10%, 8% is now in line with where the price is. In other words, what this says is even if Inmode is able to grow their free cash flows by 8%, that's it, just by 8%, the company right now is trading at its intrinsic value. Okay, and my fair value has been sub $20. I think it's closer to $19.95, closer to $19.90. In the past is what I've calculated for Inmode, and right now, of course, it's trading at well over $20 per share right now. So, you know, it is trading at a quite reasonable to low valuation, as we've already discussed. And the biggest question mark that this carries is going to be whether there is a future potential for Inmode to scale and to grow revenues, considering that it is a very, very product-oriented business model, and there's not a lot of scope for recurring revenues or stickiness or subscription type revenues, which is really, really important for any type of business to generate that recurring revenue and to keep going moving forward. But fundamentally, as it stands, excellent balance sheet, very good margins, cheap valuation, good growth, but the future is a big question mark. So I want your help to better understand what you think in this industry, in the cosmetic surgeon industry, in the medical health technology industry and sector, and what you believe is the potential for Inmode moving forward. But like I said, I mean, the stock is trading at really, really cheap valuations with an excellent balance sheet. So bankruptcy risk is really low, but it really depends on whether there's growth in the future for the revenues and earnings or not. So support level is going to stay put at 1885. So this right here is going to be that level to watch as a support, and resistance stays put all the way up to 26 to as much as $29 per share for the company. And again, we're going to be watching a little bit of a gap down, but the company's kind of gone through this process over and over again where they cut their guidance and then over deliver in the earnings, in the actual earnings when they release those numbers. So hope you all enjoyed this video, found it helpful. Make sure you drop a like. Let me know your thoughts down in the comment section below for Inmode. As always, links to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the members-only private videos, Excel spreadsheets, everything's going to be included. As always, happy investing. I'll see you all in the next video.